We want to talk about the Santa Claus Rally. And I think there's a lot of false information that goes out about that, especially in December. Anytime the market goes up, it's like, hey, Santa Claus Rally. Well, that's not really what it's about. And I think it's worth, first of all, talking about what that is. And then I'll talk about how, with the context of the market and where that could, and how that could play out. But I thought Tom McClellan did a great job on Twitter. It was actually yesterday about how the Santa Claus Rally concept came decades ago from Yale Hirsch. And it was talking about the last 5 days of December and the first 2 of January. And what the thought was is that if the market went up from Christmas until just after New Year's, that was a good indicator of how the next year should play out. And that's what the Santa Claus Rally is, and it always has been. Now, for some reason, you watch financial news these days, or even many newsletter writers saying that, oh, the market went up last week in December. Must be a Santa Claus Rally. Well, that's not really the correct thing. So I certainly want to get that straightened out first, because I think it's an important thing to mention. But I love this. The best use of the Santa Claus Rally term is to allow you to evaluate the education and professionalism of those who toss around the term inaccurately, as it can help you assess such a person's credibility generally. So yeah, there's a lot of iffiness about people who throw this around who really don't understand what the Santa Claus Rally is. We're going to look at that near the end, and I'll show you the data, like where we are in the cycles and how that could play out. And we could still have one, or maybe we're done now and maybe we don't. And maybe that's bad for next year. And that's something we're going to explore a little bit. So currently the advanced declines are climbing, and that's, no surprise. The market's been pretty strong until when it bottomed right in the last-ish day of October. We kind of had expected the market to bottom early October, but it really just kind of struggled until the end of the month, and then it really took off. And we've participated in a lot of that. I'm very happy about how we've been. But then, okay, great. Now what do we do? Things are starting to slow down. Things are starting to weaken. So I want to pay attention and see when we need to start playing it safe again. Money flow, of course, obviously was strong since the 1st of November. And then now in the last couple of weeks, maybe a week, it's really weakened a lot. And so the strength is not really behind the move anymore, even though the market does continue to go up. And that's something worth noting as well. I'm not sure if we're up today or not. We were earlier. If money flow can't stay up, this might be a reason for us to start pulling back our allocations and being less invested going into the second half of the month, which is really not what we were expecting to do, but it is what it is, and we try to play it out as the data tells us to. Super interesting. The NASDAQ was weaker against the S&P until a couple of days ago. And that's interesting, because usually with the NASDAQ leads, that's when the market is strong. When the S&P is stronger than the NASDAQ on a relative strength basis, usually that's not as strong of a market, because you want to see tech typically leads the market. And then an odd, I haven't seen small in leadership against the S&P or against the NASDAQ in quite some time. And I'm not really sure why, other than it's just been beat down so much over the past several years. It really hasn't gone anywhere. I mean, as of a month and a half ago, it was not even positive year to date. So that was interesting. So, but there's also seasonality that suggests that small cap is the place to be for this next little bit. We haven't moved into it yet. We're in a couple other things that seem to be working fine, but that's where we are there. And then again, kind of to piggyback on the NASDAQ S&P thing, is if growth is beating value, that's good for the market, but value is beating growth. And that's not an indicator of a strong market. Maybe we're slowing here, maybe we're not, but either way, we have leveraged is beating the non-leveraged in the S&P and the NASDAQ, and that's pretty consistent. So I think we're strong so far. But of course, we'll see if that, as things weaken, we may see those drop off, and that's something we're certainly watching about when to get safe. Sector selection. Sectors 10-1 positive. That's pretty good. Energy just cannot seem to go positive. I think it was up this morning last I saw. Relative to most other sectors, most things have been strong in this rally, and that's really something you want to see that really inspires us to be invested fully and really to try to take advantage. And then as these sectors start moving over to the other side, then we're like, well, we should start backing out. But at the moment, energy just can't catch a break, as they say, or catch a bid, as some say. However, seasonally, the spring, usually the April, May is usually the best time for energy. So I'm keeping that in mind, and that might be something that we dive into a little more aggressively than we normally would in that time of year. But that's going to be for another monthly webinar. So a lot of these are also stretched quite a bit. They've been positive for, utilities have been positive for 45 days, 30 days, 29. We're getting a little long in the tooth on these sector strength. And typically over the past couple of years, usually once it gets over 30 days, it gets tired and starts weakening pretty quickly. But what's interesting is we have materials, technology, and then consumer staples. So the defensives, this is a very odd mix of grouping. are all turning positive again. So we might have a little run up that continues into the end of the year. If these can stay on the positive side, then I'm positive about that. But what's been really interesting is as the market has gone up in this past week, we've had all the sectors falling from leading to weakening, right? So usually that's an indication that the run is done. It's time to start playing it safe. And we were right on the edge of doing that. I think we have in little cases, like every time it's a good day, we'll peel off a little bit of profits just to keep them in our pocket, and then we'll save them for another day. Energy, of course, on its own over here is just having a rough time. But now we're starting to see these little guys pick back up and point up into the right again. If we see more of that, we could actually have another run for another week and even into the year, and we could see the Santa Claus Rally on the last 5 days of the month. So that setup is there, and I'm certainly keeping in mind. But it's interesting how we're seeing weakness that we thought we should have seen in the market. And seasonality agrees with that. Seasonality, where we are right here, we should be not necessarily struggling, but it's a weak period until about the 20th. Historically, over the past 10 years, the market's not very strong from here, December 1st to about December 20th. We're halfway through that, so we could actually still see weakness. What was interesting is seeing the sectors fall down and get weak. That totally was in line with this, but the market kept going up, and that was a very odd disconnect, and I'm not exactly sure what happened and where we missed something. But that's certainly something to note, and then here's a good little rally into Christmas, and then you kind of see where it goes after that. It could be up, it could be down. It's a little less sure, but it's an indicator of what's to come in the future, so we'll definitely be watching where that goes. And then finally, based on the Fed's news yesterday that they said they're going to start cutting rates starting next year. I thought this was a great headline that I saw again on Twitter. Fun place for these kind of weird informations. But Wall Street extends rally after the Fed move, and the Fed move was cutting rates. So what happened after that? Well, this was from September 20th, 2007, right? So when they started cutting rates, that was not a great sign for the market going forward. And that actually was very, very near the top of the market. I'll just show you that. Right in here, September, that's where they started cutting rates. And then we had a little rally, and that's what they were alluding to. And then we had 2008. There are a lot of situations out there, a lot of credit problems. I'd certainly love to see rates come down to help the housing, but we're seeing more defaults in consumer credit, in automobiles. We're seeing a lot of iffy things. And Will talked about these last month in his webinar. There are a lot of issues out there that need to be resolved. It may be too far on this interest rate run up that to really save it. So we'll have to see. There's a lot of talk about soft landing. I'm not sure I believe in that. I also, I didn't believe that inflation was transitory, and it certainly wasn't. So here we are. We'll have to see how this plays out. But this could be a great time to get defensive if we see a repeat of this. I don't necessarily think we will. We shouldn't. Not for another couple of years, at least the long-term cycles don't say so. But where we are now, I certainly want to be aware that this could happen, and how do we protect people's money in that situation?